Good evening, everyone. Today we have a really special guest for today's AMA, Ask Me Anything. Now, if I go on talking about this person, I think it'll take up the whole session, so I'll keep it very crisp, very brief. He is the founder of Stellar Wealth Partners Private Limited, a SEBI-registered research analyst firm, and he is also the founder at Chapter, which is a curation-based learning platform where it teaches the discipline of investing. And furthermore, he is also the author of the international bestseller on value investing, The Joy of Compounding. Please welcome Gautam Baid, CFA. It's so great to have you here. How are you feeling today?
Thank you for the kind introduction, Abel. It's a pleasure being here.
Awesome. So I just wanted to say before we start off today's questions, we'll be dealing with a lot of users, a lot of questions. But we can start off with saying, hi to who all are actually here early. So Jitendra Pachlongia says hi. Hi, Jitendra. Rajiv Kumar says hi. Susanta says hello. Hello, Susanta. Vijay Kumar, hi. And Rishant Kant says hello, Gautam. So everyone, we'll be waiting for, a few more audiences to join and to ask their questions. But in the meantime, so Gautam, tell us a bit about your investment journey, how you began and where you are right now, and how the journey has been adventurous, as you had, you said before we joined the call, so that the audience could know a bit more about you.
Sure, Abel. So I've already talked about this on various forums in the past as well. I'll just repeat the same here for the sake of the audience who do not know about my journey. So I was born and brought up in a Marwari family from Kolkata. And as you very well know, the Marwari community in India has got business in its genes. So ever since my teenage years, I was always fascinated by the concept of entrepreneurship, especially by the fact that once a solid foundation is established for a business, the owners do not work for money, rather money works for them. And I did my graduation in accountancy. So pursuing higher studies in the field of finance seemed like a natural extension. So I did my MS in finance from ICFA University, Hyderabad, India. And I also did my MBA in finance from Nirma University, Ahmedabad, India. Later on, I also went on to obtain my charter from the CF Institute, US. After my MBA program, I got campus placement into Citibank at their Mumbai office in their investment banking team as an analyst, where I worked for 3 years. And from there, I joined Deutsche Bank, where I worked for almost 4 years at their London, Mumbai, and Hong Kong offices as a senior analyst in their investment banking team. Now, throughout those 7 years of my investment banking career, even though I was making very good salary income, but the very nature of that particular field did not suit my personal nature. And one fine day, I just came to the realization that we just have this one short life to live our dreams. And I did not want to waste any further time doing something that I was not truly passionate about. What I was passionate about was the Indian stock market. And like most new investors in the market, I got my start in the stock market by being pulled into it out of sheer greed during the final euphoric phases of a bull market. In my case, it was the 2003 to 2007 bull market in India. I basically had invested in some power sector mutual funds and steel stock towards the very fag end of that bull market. And within 12 to 18 months of my purchase, both those investments had crashed 70-80% because, as you know, recency and vividness biases are very costly behavioral mistakes. But despite this bad initial experience, my interest and curiosity about the stock markets always remained very high throughout the first 7 years of my professional investment banking career. And I was so keen for a career shift that in May 2015, I relocated to the US. One of my very close relatives, he's a US citizen. He sponsored my green card. And within the first 6 months of coming to the US, I gave 3 stock market job interviews, but I was unable to convert any of them because I lacked the intellectual foundation to succeed in investing. At the same time, I ran out of whatever little money I had brought with me from India. And to take care of my living expenses in the US, I took up a minimum wage job as a hotel clerk at a hotel in San Francisco, where I used to work during the graveyard shift. Now, for all of you who don't know what the graveyard shift means, it was a shift that ran from 11 p.m. at night to 7 a.m. in the morning. I worked at that particular job for 15 months. And even though it was a big struggle for me physically, emotionally, culturally, and intellectually, for the first time since the beginning of my career, throughout the first 7 years of my busy investment banking career, I did not ever have the time to read and learn and invest in my personal development. But the pace of work during late night to early morning at the hotel was pretty slow, and I made full use of the free time to read up every single blog article published from inception till date on blogs like Safal Niveshak, Fundu Professor, Janav WordPress, Basic Investing, and Microcap Club, among others. And the passionate pursuit of lifelong learning had finally begun. Now, luck, chance, serendipity, and randomness have always played a big role in various aspects of my life till date. One fine night during November 2016, while working at the hotel, I randomly clicked on the quick apply button on a job application on LinkedIn, and wonder of wonders, I was shortlisted for the interview, and that too for a senior role in an investment firm, even though I had zero formal stock market work experience. And this was the phase in my life during which I was about to realize the power of compounding knowledge in action. You see, all those previous 15 months at the hotel, reading all those blog articles, had now built a strong intellectual foundation for me in investing. This is what I was lacking during the first 3 stock market job interviews in the US. But this time I was able to successfully clear all the 3 rounds of my job interview, and I was offered the role of portfolio manager. And it was like a dream come true for me, because I'd never expected that I will straight away land the job of a portfolio manager. I thought I'll be hired as a junior analyst, then get promoted to analyst, then to assistant portfolio manager, and probably then finally to portfolio manager level after 12, 13 or 14 years. But this is how compounding works. The power of compounding is backloaded, and the compounding will bestow its magic and benefits upon you only after testing your patience and conviction to the fullest. So never give up after putting in all the hard work and effort. In fact, Thomas Edison had very famously said that most of life's biggest failures are people who did not realize how close they were to success before they gave up. So never give up, because you just keep on going, because you never know when you're going to hit it big. I worked in Summit Global Investments as a portfolio manager for 4.5 years. I quit my job 7 months ago at the end of July 2021. And around the same time, I joined Chapter as one of the founding creators, because the mission of the founders of Chapter really resonated strongly with me. The founders of Chapter want to make learning very accessible and affordable to the masses across the world. And I teach the discipline of investing series on their platform. And also, I set up an investment firm in India last year, which got the SEBI Research Analyst corporate license a few months ago, and we have launched our small case products for investors in the Indian stock market, gotten up to a very good start. And I think given the current very attractive valuations in the market, it's very heartening to see a lot of new subscribers opting for our small case products and making full use of the lower prices in the market to invest for the long term. It really shows that a lot of the investors in India are becoming increasingly mature and developing a long-term mindset and having strong belief in the India story. So that is what we are here for. We are here to build generational wealth for our clients over the long term at Stellar Wealth Partners, and we're looking forward to a very exciting journey together.
Amazing. So first off, congratulations. And I have to say, maybe your next book can revolve around your life and your struggles. And, it's very inspiring to always hear, the roots and the underdog story, so that we can root for. And it feels really, heartwarming to listen to your story, your anecdotes from your past and where you've made it. And it's a great honor to have you today, to talk about investing. I know it's a really hard time, because after markets, it's the time you take a break, but then you're here to educate and answer questions directly to our viewers. So it really means a lot. So starting off, we have one question from Kalyan Chakravarti, who says, hi, I am a subscriber of Stellar Wealth FC portfolio with quarterly limit on a number of transactions from my organization. I am unable to do regular SIPs. Can I invest in stocks which were beaten down due to market crash?
Well, if you want to reap the full benefits of paying the annual fee, you should ideally strictly follow our model portfolio at all times. And as regards SIP, if you cannot do monthly or regular SIPs, we strongly suggest our clients to do SIP or invest fresh money whenever their small case portfolio falls 8 to 10% from the most recent peak value, because the long-term trajectory of the markets is up. So every time you invest fresh money on a 8 to 10% dip at a portfolio level, that's an ideal strategy to maximize wealth creation over the long term. That's what we recommend to all our clients.
Got it. So another question that I had was, what would your advice be to investors to combat, the market impulses of panic selling? So right now the markets are, all volatile. Investors don't know where to go, what to do. So what would be your advice to investors to combat the market impulses of panic selling?
the best way to avoid any market impulse, be it for buying or selling, is to completely shut off the media, because the media's job is basically to grab eyeballs that they can only, because their business model is all about generating advertising revenue. So to maximize their revenues, they need to generate eyeballs. They can generate more eyeballs and viewership by spreading fear and panic during times of turbulence. That's how they make money. So the first step is to just cut yourself out from the media and just focus on just doing the basics right, reading the annual reports, quarterly earnings transcripts, and just doing good deep research on the companies that you're investing in or tracking. I mean, just do deep work. Focus on doing deep work. Just cut yourself out from the noise. A century ago, the only source of news available to us every day was a single piece of newspaper which used to come to our homes daily, right? That was a century ago. Now, fast forward 100 years hence, and just imagine how much the noise has been amplified because of social media. The same piece of news is amplified 1,000 times over, and there's so much noise all around. And it's very important to maintain focus. Focus is the key to success. You have to just intently focus on the underlying earnings growth and the valuations of your portfolio companies. That just do the basics right, and you will do absolutely fine.
Got it. Amazing. So we have a couple of comments here, and Venkataraman Sethuraman says, "Thanks for having a genius on the show." Yeah, thank you so much for Gautam actually making it here and doing this for us. So thank you so much. We have a couple of hellos from Sandeep, Venkat. Sak says, "I have read your book, The Joy of Compounding. It's an outstanding book. So congratulations." Vijay Kumar says hi. Sarah Chandra Rapaka says, "Beautiful story. I recently purchased your book and looking forward to read and learn from it." Sunny Kumar asks, "What are the sectors that are bullish over the long term?"
So through our small cases, we have two different sets of criteria in terms of time horizon. The flexi cap small case focuses more on stocks with a 2 to 3 year time horizon, mixed with a few long-term compounders. The Megatrend small case is the one where we basically focus on very long-term structural trends which we feel will last for another almost a decade from now. In that, we have got animal healthcare, fintech, music streaming, cloud computing, e-commerce, digital transformation, CDMOs, CRAMs, as well as all the generic contract manufacturing companies, and also a lot of PLI beneficiaries are also included there. So these are the very, very long-term structural trends which we feel will greatly benefit in India over the next decade.
Amazing, amazing. Now, Sak Londa asks, "Please explain your investment psychology."
So at Stellar Wealth Partners, we focus on identifying emerging and fundamentally strong businesses based on variant perception and long-term structural trends. Variant perception refers to situations where you get ROC expansion coupled with earnings growth. That in turn leads to valuation re-rating, and you end up getting multi-baggers. And variant perception arises from having a differentiated view on the short to medium term trajectory of a business for the next 2 to 3 years. And there are multiple triggers for variant perception, namely a product mix change, which may lead to margin expansion, a very big capacity expansion or CapEx program. And that may, because once the pre-production costs are recovered, then a large part of the subsequent revenues flow down to the bottom line. Also in such CapEx plays, what happens is once the CapEx is complete and the earnings start flowing in, the company, if it has taken on debt for its expansion, once it starts repaying that debt, you get deleveraging, debt goes down, interest cost goes down, net profit goes up, market cap goes up. So you also get the benefit of operating leverage in such instances. Another source for variant perception is an industry cycle shift. For example, since the middle of 2020, the residential real estate cycle in India has finally turned around for the better after almost a decade. Another source for variant perception is a regulatory change. So since early 2020, ever since the heavy emphasis given by the government of India on ethanol blending, you have had multiple multi-baggers coming from the distillery space. Another source for variant perception is that of improvement in asset turns. This is information which you can easily get from company conference calls. You can ask them what will be the expected turnover on the new fixed asset capacity coming on stream. And ROC expansion comes from two sources, margin expansion and improvement in asset turnover. And between the two, I prefer the latter because high margins tends to attract competition. Some further triggers for variant perception comes from corporate actions in the form of demergers, promoter or management change, block deals, then divestiture of a loss-making unit or business segment, and divestiture of a non-core business, because many conglomerate businesses in India tend to get what is known as a conglomerate discount, but the stock market likes focus. So once those conglomerates hive off their or sell off their non-core businesses, the resultant company tends to get a better valuation multiple. Now, that was all about variant perception. And I've also talked about long-term structure, some examples of long-term structural trends. But how do you find those long-term structural trends? Long-term structural trends are found in industries with a very favorable structure. They are organized as a monopoly or a duopoly or an oligopoly at best, and they are experiencing some form of an industry tailwind. They're also characterized by consistency and predictability of cash flow, and they've got a long runway for growth. So you have visibility for many years ahead. They also tend to enjoy value migration. So in India, for the last many years, we have seen value migration from unorganized to organized, public to private, offline to online. And you get a lot of moated businesses as well when you actually focus on long-term structural trends. So these are the two key areas where we at Stellar Wealth Partners focus on: variant perception and long-term structural trends. And at this very stage, I would like to share one very critical principle of long-term value creation. So in the stock market, there are only two kinds of companies: one with low returns on capital employed, one with high returns on capital employed. In case of companies with low returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they focus on improving the return on capital employed. And in case of companies with high returns on capital employed, the maximum delta, the maximum rate of change, the maximum intrinsic value creation takes place when they focus on improving their top line or revenue growth. So in variant perception, we focus on companies which are improving their lower returns on capital employed. And in long-term structural trends, we focus on already established strong businesses which are having good revenue growth, and they're already having good returns on capital employed. So that's basically how we focus on short to medium term as well as long-term wealth creation through our two small case products.
Amazing outlook. So the next question is from Venkat Konda, who asks, can you please share your current view on the GEO tensions, Fed rate, and inflation?
So the beauty of the stock market is, I'll tell you this, there is one big thing which I've come to realize over the last 15 years of investing is that there is always a bull market going on at all points of time in the Indian stock market. So between 96 to 2000, it was in technology, media, communications. Between 2003 to 2008, it was in infrastructure, real estate, organized retail, commodities. And between 2009 to 2014, it was in discretionary consumption, pharmaceuticals, IT services, FMCG. Between 2015 to 2018, it was in autos and financials like NBFCs and microfinance companies. And since March 2020, we have had a new bull run starting in multiple subsegments within India's manufacturing industry, especially with the focus on import substitution. So forget all this macro noise. In fact, Warren Buffett in his letters has also written that Berkshire Hathaway has made some of its best purchases when the noise around some macro fear was at its peak. You have to focus on companies where the earnings power and the earnings prospects is improving while the stock price is falling, because in such cases what happens is those stocks become like coiled springs. They are just waiting to burst on the upside once the market stabilizes. Those are the stocks you need to focus on. The companies which are reporting blockbuster quarterly earnings along with very bullish commentary, announcing very big capex programs, indicating their bullishness about the future. This is the time when most of your competition in the stock market will be wanting to wait it out till further clarity emerges. But the successful investors are the one who will put in the hard work right now to do the research and find companies whose earnings are accelerating. Just ignore all the noise around inflation, interest rates, the geopolitical tensions. Those will basically lead to quotational losses. See, as investors, we need to differentiate between quotational losses and permanent losses. Quotational losses are inevitable and perfectly fine, perfectly acceptable, because they are short-term in nature. It is the permanent loss of capital which is long-term and permanent by definition. So that is what you need to avoid. Most of the investors who don't focus on the downside, what they do is they end up chasing low quality towards the fag end of a bull market and go down the quality ladder. And once the bear market starts after that, all those kachara cap, bangar caps, and bad quality stocks just crash and never see those levels again for many years till the next bull run takes place in the future. You want to focus on good quality businesses with good quality managements, which are now finally available at a reasonable price because of the recent correction. Many good quality small cap, mid caps have corrected by 30 to 40% in the last 2 months. This is the time to put your head down, get to work, and focus on building a good portfolio for the long term. And in case you're already invested, and if you don't have fresh money to invest, just do nothing. Just this, like all past episodes of Macro Fear, this too shall pass.
Understood. Amazing. Next question is from Rakesh Mane, who asks, where should one invest if one is already invested in both stellar wealth small cases?
I think one of the most exciting areas for investing in today's global markets is the US tech sector, because a lot of the US technology stocks have corrected 50 to 80% from their peak prices. The market caps have now become really, really attractive. Some very strong businesses have also sold off in the tech correction in the US. And to take care of the global tech exposure among investors in India, I do plan to launch a small case for the US technology industry later on this year. Once the small case gets the regulatory approvals and the necessary approvals, then I do plan to launch a small case for the covering the US and global technology sector, because the value which has emerged there after the bear market is just tremendous. Probably on a risk reward basis today, the US technology sector is looking the most attractive to me globally.
Amazing. So that would be a great opportunity for a lot of investors to invest in a new area or a new avenue that is completely different, right?
Right.
Yeah. So thanks a lot for that. The next question is from Sushanta Kumar Das. What do you suggest as a small retail new investor to go for paid small case or small case which is available for free?
I think rather than opting for the free small case, you can ideally, for opting for a free small case, if you don't want to go for the paid small cases, you should start off with a low cost index fund to begin with, just to get a feel of how the stock market works. Then probably graduate to a free small case, and then finally go for the paid small cases. And just keep learning along the way. There's nothing better than actually educating, because the most exciting part of investing over the long term is not just the wealth creation, it's the learning which takes place along the way. This is a profession in which you're getting paid and becoming richer, wiser, and happier every day with each passing day, because of the tremendous intellectual rigor which it brings to the table. So just keep learning.
Understood. Sachin Jaiswal asks, can you please give your views on Solara, Active, Pharma, and Caplin?
So I don't have any views on Caplin Point. I have had a look at Solara in the past. This is not a stock recommendation, just a general view. It's now available at a commodity multiple, and that's rightfully so, because it's actually largely a commodity ibuprofen business. But over time, if they're able to, if the management is able to achieve what they have been stating about increasing the proportion of the CRAMS business in the overall business mix, then the valuation multiple may re-rate and you may get a good valuation re-rating, but it will ultimately be a function of the execution, which looks pretty challenging in the current circumstances. In the most recent quarter, we saw what happened. It was a kitchen sinking quarter where all the bad news came out at once. The existing MD CEO resigned, and basically it was more of basically the company is now starting afresh. So pretty high risk, but we have to carefully watch the execution from the current levels, how the new management executes on the business's long-term plans of reducing the ibuprofen piece and increasing the non-ibuprofen, the non-commodity part of the business over time.
Right. Thank you for that. And Sandeep Ramkar, sir, need to understand those companies who are market leaders and low debt companies mostly involved in the CDMO space.
So, are they asking for company names or the prospects of these companies?
I believe they're trying to get company names. Need to understand those companies. I believe what Mr. Sandeep is asking is...
I would highly recommend anyone wanting to get a good understanding of the CDMO industry in India to watch Sajal Kapoor's videos, which are freely available on YouTube. He's also done a webinar on India Investing Conclave, and the sign up on that particular website is free. And you can also get access to his webinar on IIC, India Investing Conclave website as well. Go through those presentations and webinars, and you'll get a very strong understanding of the long-term promising prospects of the CDMO industry in India, along with some very good names as well. we do have a good exposure to CDMO and CRAMs in our Megatrend small case because we believe they are a long-term structural trend.
Amazing. Could you please repeat once more the speaker's name so that the audience can catch it once again?
Sajal Kapoor. Yeah, he goes by the Twitter handle of Unseen Value.
Unseen Value. All right. So viewers, please check out to gain a lot of information inside the CDMO space. The next question is from Tanuj Singh Sadhu. Hi, I'm a FlexiCap subscriber. When I invested in Jan End, it had 31 stocks. Today, when I am planning to invest more shares, it shows 28 stocks. Have we gone through any rebalancing? And did I miss it?
We have gone through a rebalance last in early January. I would say it was around 10th or 11th January, I believe. And right now, because of the recent correction, I'm actively researching on two stocks in my watch list. We may replace one of these stocks in our FlexiCap next month with probably one of those two stocks next month, possibly. But I'm still in the process of researching on these two names in an extensive manner.
Got it. So Tanuj, I think the rebalancing happened in the first week, the beginning of Jan.
In the second week of Jan. Yep.
Week of Jan. So please go through it once more. Kumar Vishal asks, fully invested in the Cerebral small case at the peak. No funds to add at lower prices now. Is it a good idea to borrow at a low rate and add at these low levels to make the best of the low prices?
It's entirely a function of your risk appetite. Personally, I would never borrow to invest in the share market because I'm at a stage in my life where I'm focusing more on stress adjusted returns rather than absolute stock price returns, and debt leads to stress, and I like to live a stress free life. I think because our small cases are made up of very good quality stocks, it's just a temporary correction, nothing much to worry over for the long term investor. Just stay put. And personally, I would recommend not to borrow and invest in the share market. Rest is obviously it's your.
Understood. The next question is from Bairaya Muturi. So, hi Baraya. He asks, I am the investor of Stellar Megatrends. Your focus on New Land Labs and FSN e-commerce, which fell nearly 29%. I fail to understand what the question is. I think the person was making a statement.
So I would basically ask, request our subscribers to avoid discussing our small case model portfolio stocks in public. And the advantage of our approach is because we follow a very diversified approach. So even a serious fall in any single stock does not really impact the overall portfolio level return much, because we have a philosophy of letting our winners run and not adding to our losers too much. So that is basically over time what's going to happen is you'll notice that the portfolio will naturally concentrate itself in the top winners, and the losers, the losing stocks will fall by the wayside automatically, as you know, because the winners will keep gaining a larger allocation in your portfolio over time. So just focus on the overall portfolio level returns over the long term. In the short term, it's too shortest time span to make any judgment.
Amazing, understood. So Baira, if you have any questions, please drop it down, and I request all the viewers to refrain from discussing portfolio strategies or models in public. The next question is from Gurunath Swami. Your views on new age businesses like Nykaa, RateGain. How do you see these businesses?
Well, just a standard disclosure here. We do own Nykaa in our Megatrend small case, and that of all the new age businesses which have recently got listed, that is the business model which I'm the most bullish on. I think it has got a very promising future. It had listed at a very high valuation. I think a large part of that froth is correcting, but over the long term, I think this business should be value accretive to its shareholders and should be fine in the long term. On RateGain, I haven't really said it in much depth, and of all the new age listed companies in India, I'm most positive on Nykaa.
Amazing. The next question is from Deepam Raj, who asks, what are your thoughts on diagnostic companies like Dr. Lalpath?
I think they have a long term. They are basically more of the consistent compounder type category, high valuations with steady growth. If you remain invested for the very long term, we should do pretty okay. But if you want to generate outsized returns from the share market, I would recommend looking for deep value plays or growth at a reasonable price, because Growth at a reasonable price is a strategy which has always worked very well in the Indian stock market across market cycles, be it a bull market or a bear market or a range bound market. This is one strategy which creates wealth across different market cycles. Growth at a reasonable price. So Dr. Lal Pathlab's very well managed company, but I'm not too comfortable with the valuations here. I'm ready to pay top dollar valuation only if I'm getting very high growth in the company. But in case of Dr. Lal Pathlabs, the growth rate, in my view, is not fast enough to justify the very high valuation.
Got it. The next question is from 5246 Kaushik Garai. So Kaushik is asking, increasing coal and oil price can affect what different sectors?
It will affect most of the sectors. In fact, because it will affect the transport cost and logistics cost of almost every business in India. So this is the time when companies with pricing power will come to the fore, and brands with pricing power and the ability to pass on the increased cost to the customers. Those are the ones that will do very well in this kind of an environment. These are the kind of businesses you want to focus on. But yes, in an environment of rising oil prices, and basically I personally feel once the Uttar Pradesh elections and the upcoming state elections are over, given the current international crude prices above $100 a barrel, it's almost inevitable that there will be a very sharp increase in the retail fuel prices in India in the next sometime over the next few weeks, unless the government cuts excise duties on petrol and diesel. So one should brace for inflation, and if you want to preserve your purchasing power, you have to identify businesses with pricing power.
Understood. The next question is from Rahul Nath, who asks, what are your views on special situations?
Special situations are a great place for generating alpha, especially in expensive bull markets. If you're not comfortable with the valuations of many stocks in a bull market, special situations provide you with value stocks, which are basically available at a good value, along with a catalyst or a growth trigger. So just to give an example of a special situation, in August 2020, the stock of CG Power was sub 10 rupees. And in 2019, CG Power had been hit with a 3,000 crore rupee fraud, and the corporate governance standards were very abysmal, and the perception among stock market investors about this company was very bad. In August 2020, entered the Murugopa Group from South India, which has a very high standard for stellar corporate governance. And in the stock market, what happens is, when a company with low perceived standards of corporate governance gets taken over by another company with very high standards of corporate governance, you have a recipe for multi-bagger returns. Since August 2020, the stock of CG Power has given more than 1500% returns just because of this management takeover. So special situations in the form of promoter management change are very, very powerful. Another very good source for wealth creation through special situations is that of a market cap demerger or a sectoral demerger. Let me explain how these two kinds of demerger work, because in these two demergers, you get an element of forced selling. So a good example of a market cap demerger is the demerger of Aarti Surfactants from Aarti Industries in August 2020. What happened was that the institutional investors or the institutional fund investors in Aarti Industries, when they were handed over shares from the demerger of this tiny microcap called Aarti Surfactants, because those institutional funds were not allowed to invest in stocks below a certain market cap, they were forced to dispose of their Aarti Surfactants shares in the open market for whatever price they could fetch for it. And that is why the stock of Aarti Surfactants fell 40-50% post the listing. And people were able to get access to a decent business at a very low depressed market cap and depressed valuation. Subsequently, the stock of Aarti Surfactants from August 2020 till middle of 2021, it gave 700% returns to investors. So that is an example of a market cap demerger. The second area of wealth creation through demergers is that of a sectoral demerger. So Jubilant Ingravia had got demerged from Jubilant Life Sciences in early 2021. And even though Jubilant Ingravia listed at a decent market cap, because it had got demerged from Jubilant Life Sciences, which was primarily held by pharmaceutical funds, those pharma funds, by their very mandate, were not allowed to hold on to a chemical stock from the demerger in their portfolio. And that is why they were forced to dispose of shares of Jubilant Ingravia in the open market at any price they could get. And that's why the stock of Jubilant Ingravia also fell 40-50% post the demerger, post listing. And people who subsequently invested in Jubilant Ingravia were able to make more than 200% returns over the next 6 months. So if you want to make really big money from demergers, a form of special situation, focus on market cap demergers and sectoral demergers.
Got it. Thank you. That was very eye-opening. The next question is from Sandeep, who asks, "Sir, need to understand your view on renewable energy industry, mostly for solar from low solar wafer or I'm sorry, I can't understand, or PV price per watt and lowest bidding cost of power sub rupees 2. So is there any sector risk ahead?"
I think this sector will always be at risk of facing intense competition from overseas markets, especially from China and other markets. But I believe the government has imposed countervailing duties or anti-dumping duties on certain products in this industry. So I think I don't track this renewable industry too closely, but if investors do want to participate in this sector, they should look for stocks which are benefiting from government policies in the form of anti-dumping duties, preferably.
Understood. So Govind Yadav asks, whenever we replace an existing share to another share, do charges apply or do they not in small case?
There is no extra charge for a rebalance. All the annual fee remains the same, irrespective of multiple rebalances or multiple SIPs. There is no extra charge.
Got it. Raju GP asks, is the Z Entertainment merger a good opportunity with attractive valuations right now?
It is attractive valuation because Sony has offered to acquire Z at a price of 300 rupees per share. The current stock price of Z is much below that, but the future value creation from this merger completely depends on the deal getting all the regulatory approvals. Because if the deal does not get regulatory approval, then all the bets are off. Then you will be ending up with a value trap. You may not really get much upside from here.
Understood. Vijay Kumar asks, "Sir, what is your view on Zomato?"
Well, they are making all kinds of acquisitions in many non-related areas and unrelated areas. So I generally stay away from serial acquirers. I like to focus more on long-term organic revenue growth, because so there is a great book on valuation which is titled Valuation, Managing and Measuring the Value of Companies. And in that particular book, the authors write, and I quote, that the maximum wealth creation over the long term takes place in companies with high organic revenue growth and high returns on capital employed. So when I say organic revenue growth, it is growth without acquisitions and without any mergers or other corporate actions. So companies which can grow organically from their internal accruals using minimal or no debt, those are the ones which provide maximum wealth creation in the long run.
Right. The next question is from Gurunath Swami, who has 5 sectors you think are bullish for the next 5 years.
That will come in our Megatrend small case, which I've already talked about. I'm very bullish on the music streaming industry in India, as well as the animal healthcare industry, the fintech industry, CDMO, CRAMS, cloud computing, digital transformation, e-commerce. There are many industries with a very healthy long-term outlook in India.
Right. Deepam Raj asks, your views on the steel sector. Is the cycle over?
Well, any long-term bull market in commodities or steel in particular is characterized by very sharp drawdowns in between. I think with the recent geopolitical developments and the huge amount of sanctions on Russia, I think the prospects for certain commodities, in particular aluminum in particular, looks very, very promising. The aluminum market is expected to be in deficit till the end of next year. On steel, I'm more bullish on aluminum than steel, to be honest. And this belief is further reinforced. But if you just look at the stock price action, so see, whichever stocks break out to fresh 52-week highs, even during a market crash, they are basically giving you a signal. They're telling you something. So just look at what happened today in Hindalco, for example. The stock of Hindalco hit a 52-week high today. And there is a micro cap stock which provides a critical input to the aluminum industry in India, when that stock was up 8% today in trade. And this itself is telling you, where the puck is going. The prospects for aluminum are really, really very, very strong over the next 1.5 to 2 years. So that is the area, I think, not the non-ferrous piece. That is where I would focus my attention.
Understood. The next question is from, again, Gurunath Swami, who has your views on Aarti Pharma, special situations. I think that's covered. Is it the best opportunity after listing? Same like Aarti Surfagant?
Yes, good question. So it won't be like Aarti Surfactants. It will be like Jubilant Ingredient. It will be a sectoral demerger. So later this year, Aarti Pharmaceuticals will be getting demerged from Aarti Industries. And even though it's a well-managed pharma company, it may get listed at a decent market cap size, because Aarti Industries is primarily held by chemical mutual funds and chemical funds. When they get shares of a pharmaceutical stock after the demerger in the form of Aarti Pharmaceuticals, they'll be forced to dump the shares of this good quality pharma business at whatever price they can get in the open market. And that is where the opportunity may arise. Not a stock recommendation. Do your due diligence and research, and only invest if you get it at a attractive price.
Understood. Govind Yadav asks, what are your views on JK Tyre, Apollo Tyre, and IRFC?
So the tires, rather than see, it's my firm belief that to succeed as an investor, you need to focus on value creation, and competition acts as friction for value creation. So instead of focusing on the tire manufacturers or the tire OEMs, why not focus on a tire ancillary company, which basically is enjoying a pole position or a dominant market position in providing a critical input to the tire industry? That is the way you should basically try think like as an investor. Try to look for areas where competition is minimized. At the same time, the company is providing a critical input, a critical application, which forms a small percentage of the overall cost to the end customer. In this case, if the end customer is the tire industry, this tire company which you mentioned, then I would rather focus on a tire ancillary company which provides a critical input to the tire industry and is having a dominant market share in that particular business in India. That is how I would play it.
Amazing. The next question is from Jay Narzari. Hi, Jay. Jay asks, what is the future of the EV sector in our country?
Same answer here again. There'll be hyper competition among the many OEMs in 4-wheelers, 3-wheelers, and 2-wheelers in the EV space. Here again, I would focus on auto ancillary companies, which are the sole supplier of a critical component to this electric vehicle manufacturers. There's no doubt that the growth rate of this EV industry is going to be very, very high over the next 10 years in India.
Amazing. The next question is from Rajiv Kumar, who asks your views on what is the best way to play with the CapEx theme and with some example.
So CapEx theme, if you just look at the PLI schemes of given by the announced by the government, and if you just look at the amount of PLI benefits being given to the auto ancillary sector and the API industry and various sub-segments within pharma industry. In fact, there are multiple sub-segments within India's manufacturing industry which are going to greatly benefit from the PLI scheme or the Atmanirbhar Bharat scheme. So that is where we should, I think a lot of big multi-baggers are going to come from over the next 4 to 5 years. And we do own a few of them, those beneficiaries in our FlexiCap and Megatrend small case, both of them.
Got it. The next question is from Naman Doshi. What are your views on high PE ratio stocks with good quality and excellent management? Pidilite, Asian Paints, Bajaj Finance.
I think those are the most vulnerable to valuation derating in the current environment. If at all you want to invest in high PE stocks, if you want to pay top dollar in terms of valuation, look for companies which are having very, very high growth to justify that valuation. For example, we chose to invest in Nykaa because it's expected to have very, very high revenue growth, and it has very good unit economics. And over time, the valuations will become more sane and much more reasonable because of the sheer growth that the company is showing. But in case of companies with 80 to 100 P trade, which has got 10-12% top line and bottom line growth, those are the companies in which I think the upside will be very restricted or negligible over the next few years. There are a few companies you want to be very careful in today's environment. So let me break this down for everyone. Because of rising interest rates, the most vulnerable stocks which are vulnerable to derating are those high P stocks with slow growth, as well as the loss-making new age companies. Those are also very, very vulnerable to rising interest rate environment because the easy liquidity environment is gone. And those companies will be getting derated. We are already seeing what's happening to many of those new age technology startups which has got listed in India. Many of them are down 40 to 50% or even more in some cases. So that is one area of the market you should be very careful of investing. The high P stocks with low growth and the loss-making stocks which are being valued on price to sales ratio, which got recently listed. That's one area. The second area where you want to be very careful is the companies with very high debt. because in a environment of rising interest rates, many of those companies tend to default and they tend to go down under, and investors end up with permanent loss of capital. So be very careful in indirect companies. As we all know, corporate India is heavily deleveraged over the last few years. But even after that deleveraging cycle, if there are certain companies which have not been able to reduce their debt, then we should be very careful of investing in such companies in a rising interest rate environment. And third and most important, the bhangar caps and the kachara caps and the low quality micro caps, those should be now avoided at all costs, because as we have seen after January 2018 till March 2020, many of those bad quality stocks fell 80-90%, and many of them have not even seen those stock price levels which they saw in January 2018 even till today. So anyone with experience in the stock market who was carefully watching the screen, if you watch the screen up to end of December, you could clearly sense there was distribution of all these bad quality kachara caps happening among the retail crowd by the investors who were dumping these stocks onto the public. It was very clear, because when you get such bad quality, a long list of bad quality stocks hitting 10-20%, 5% upper circuit on a regular basis, that generally takes place towards the very fag end of a bull market. And I've talked about the same in my book as well, how to identify which stage of the market cycle we are in. And it was very clear at the end of December that we were basically entering a euphoric blow off top in terms of the stock price action in the bad quality space. So I think those three areas are the areas which should be avoided in today's environment: the high P, low growth, the loss making high growth companies, as well as the highly indebted companies, and the bad quality micro caps. I think these are the three areas of the market investors should avoid.
Understood. So the next we have a very interesting question. Atharva K asks, how can we copy Warren Buffett through small case?
By having a very long-term mindset and believing in the power of compounding. That is what we believe in very strongly at Vesta Level Partners. We are focusing on long-term wealth creation and building generational wealth. And that takes place only when you focus on endurance and durability. That is what we focus on at Vesta Level small case. So if you compound your capital at 20%, then over 25 years, your capital will become almost 100 times, which means that if you invest 10 lakh rupees in the beginning, your capital would become almost 10 crores at the end of year 25. For many Indian families, that is actually generational wealth building. But you should note that the power of compounding is backloaded. And out of that 100x, which you make over 25 years, almost 62x or almost 2/3 of the 100x comes in the last 5 years. At the end of first 10 years, you'll have 6 times your money at 20% compounding. At the end of year 20, you'll have 38 times your money at 20% compounding. And at the end of year 25, you'll have 96 to 97x. So almost 2/3 of the 100x came in the last 5 years. And this is why long-term investing is so challenging, and making big money from the stock market is so challenging, because the stock market is designed in such a way so as to prey on our two biggest weaknesses, that of greed and fear. That's why we keep making the same old mistakes again and again. Many of us just keep making the same mistakes. It is only those who learn from the successful investors and who are patient, who have a long-term mindset, and who are willing to be humble and acknowledge that the market is ultimately supreme, and who are always having a sense of constant learning and gratitude, and always willing to learn from others and learn from their mistakes. Those are the people who succeed in the stock market in the long term.
Understood. So now Sanju asks, what are your views on DMart?
Again, a very high quality business, but available at an exorbitant valuation. And I think there are much better small cap and mid cap companies available at a fraction of the valuation multiple which DMart is available at and offering much higher growth. It's a very well managed company, though. All credit to the management for executing superbly on their vision. I think it's got a long run for growth ahead, but I'm just not comfortable with the valuations here.
Understood. So Surangi Shekhar asks, LIC IPO is coming soon, right? What is your view on that?
The gray market itself is telling you the view. It's currently at a discount to the, I think it's at a discount right now. So the quality of the business is in doubt by many people, because LIC has been constantly losing market share to the private insurance industry for the last many years. So, but it's just like Coal India was a landmark IPO many years back. It got heavily oversubscribed. I think even LIC, because of its sentimental value among many Indians, it'll probably get a very good subscription by many people. And also, I think the bigger picture here to look at for the LIC IPO is that it is expected that 3 to 4 crore new DMart accounts are about to get opened because of the LIC IPO. So as a investor, I would look at, there is a one particular listed stock which is a clear beneficiary. We all know which it is, of 3-4 new DMart accounts getting opened. So that is the stock which we should actually focus on, which is actually a direct beneficiary of new DMart account openings. And also in the longer term context, so with crores of new DMart accounts, today we have just approximately 8 crore DMart accounts in India, which we are talking about a 50% increase in a matter of few months because of this one single landmark IPO. So the total total market in terms of the total addressable market for mutual funds, PMSs, small case, the total addressable market just expands multifold here for many of us. And I think a lot of new investors are entering the market at a very good time when the valuations are very attractive and when India is just about to take off on a high growth trajectory led by the CapEx and real estate revival.
Understood. The next question is from Gurnath Swami, who was, I am a special situations investor. Your view on India pulls real estate, embassy acquiring good corporate governance, NCLT approval is done, but share is falling continuously.
So NCLT approval has not yet come. It was due to come in December, but they basically asked for a shareholder meeting first in February, and the final NCLT approval is expected to come soon. So the NCLT, once that happens and the as per their presentation, the merger is expected to get completed in Q1 of FY23. I think this is a good at the current price. It's a good risk reward, not a stock recommendation. Please do your own research. But again, this is a good example of a company with low perceived standards of corporate governance being taken over by another group with very high standards of corporate governance. And Mr. Jitendra Virwani, who is the chairman of Embassy Group, he enjoys a stellar reputation in India's real estate circle. So the merged entity should get a leadership premium because of him, as well as the corporate governance premium as well. So the risk reward looks pretty good at the current levels for Indiabulls real estate. And very important to note that the erstwhile promoters have basically almost exited. I think they have got just 0.26% stake left with them now. So it's now mostly in the hands of retail investors and a few large institutional investors. And once the Embassy Group completes the merger process, I think we have the tailwind of the industry cycle also in our favor, plus a new good management in place. So looks pretty good for the next few years.
Understood. Sharavanan S asks, your views on private banks and large cap infra stocks for the next few years. Has the cycle just begun?
I think the results of SBI are clearly telling us that the cleanup of their infra books and most of the legacy books is behind them, and now the public sector banks are primed for growth, as are the private sector banks. I think whenever India, for any country which is about to enter a growth phase, the lenders, be it small finance banks, be it private sector banks, in India's case, even the public sector banks now are doing pretty well. So lenders seem to be in a good spot right now, and the valuations are also very attractive. So that is definitely an area where investors should do some deep research now.
Amazing. Raju GPA asks, what is your view on SaaS companies, subscription-based companies, and PSU banks?
PSU banks, like I said, are available at very attractive valuations. But as a matter of principle, we at Stellar Wealth do not invest in government-owned enterprises because the promoter's key motivation is not wealth creation for shareholders. We are right now participating in the banking sector growth and the lenders' growth right now through a small finance bank and a private sector bank, as well as an NBFC. All three are present in our flexi cap small case. And you talked about large cap infrastructure stocks. So rather than investing in infrastructure companies, I would play the growth in infrastructure through these lenders itself.
Understood. Sachin Jaiswal asks, views on how to identify companies being on high operating leverage.
Simple. Just look at the existing capacity utilization, and also look for companies which have just completed a very big CapEx program. For example, there is a micro cap company. It's not in a small case, but it's a micro cap company catering to the aluminum industry, provides the critical input in which the fixed assets have just doubled recently. The gross block has doubled, and the entire capacity utilization from the new plant will now start reflecting in the numbers. So you look for companies which are sitting on low capacity utilization. Those are prime sources for getting operating leverage.
Right. Um, Jay asks, any undervalued, fundamentally strong stock on your radar?
Oh, there are many after the recent correction. In fact, there are companies at 10 or sub 10p multiples on a 1 year forward basis, which are expected to grow their earnings per share at 25 to 30% over the next 3 years. So a lot of opportunities have opened up after the recent correction, in which many small cap, mid cap stocks are down 30-40%.
Got it. Next question. Madhumita Ghosh asks, how to begin investing? What are the first few steps? I think the person is just starting out. How to begin investing?
Like I said earlier, like begin investing. If you're a beginner investor, start off with the basic index fund, low cost index fund, then graduate to mutual funds, and then you can start looking at small cases, and then probably a PMS later on. That is the chronology. But all along the way, do read, do keep learning, do keep reading. Some very good books I would recommend for any beginner investor include Common Stocks and Uncommon Profits by Phil Fisher, The Most Important Thing by Howard Marks, and One Up on Wall Street by Peter Lynch, and the Berkshire Hathaway shareholder letters, as well as the original Buffett partnership letters, are a great source for anyone wanting to become a better investor.
Understood. Atharva K asked a question. What are your views on Facebook and the Metaverse?
I think at the current price, you're basically paying literally nothing for the Metaverse opportunity. It's more like a free call option, which you're getting right now at the current price. I think the stock is down almost 50% from its 52-week high. So the market cap is basically halved, and the monetization opportunities from WhatsApp and Instagram still lie in store. So that's the stock market for you. It's very short. It's very myopic and short term looking in nature. And just because of one quarterly blip, the stock price has basically got hammered almost 50%. So it's a very high quality business with great free cash flows and very strong moats in place. I think the long term future looks pretty promising, and especially if they can execute on their metaverse ambitions, could create a pretty good wealth for shareholders.
And just a question from my side, because I find this. What do you think about the competition that Metaverse brings, and how do you think that also plays out into the entire ecosystem?
So again, so there are some pure play. So in the US market, there are very few pure play opportunities on the metaverse, but there are a few companies like Roblox, Unity Software. Those are basically, again, not stock recommendations, but companies which have got a pretty robust positioning in the metaverse of the future. So one should definitely start researching upon such companies. You want to basically look for companies which will face less competition because they are having dominance in a particular niche of their own. That is where I would basically focus more on.
Understood. Unfortunately, we are actually running out of time. I can see a lot of questions coming in. Gautam, is there any place where you could answer all your questions, the queries that the users have? Is there an email or a help desk that users can make use of?
So for users who are interested to know more about our small case and our investment philosophy, they can drop an email on info@stellarwealthpartners.com. I'll be happy to respond to them. And for any other queries, I'm there actively, pretty active on Twitter. So you can ask me questions there as well.
Amazing. I really have to say, I can see a lot of questions coming in. I think they just want to keep asking you questions. I had a ton of fun. And, usually it was so eye-opening to see, a lot of insights from you, to hear a lot from you. I am also a very beginning investor. Like, I'm just getting into it. I'm learning. So along with the viewers, I'm really happy and I'm really honored that I get to learn with them from you. It was an amazing experience. Do you have any parting words before we sign off?
I would just tell everyone, ignore the short-term corrections, believe in the long-term trajectory of India, believe in the power of India and its entrepreneurs. The history has taught us that the maximum wealth creation in the stock market for any country takes place when that country transitions from $2 trillion of GDP to $5 trillion of GDP. I believe today India is at $2.8 trillion of GDP. So over the next few trillion dollars of GDP addition to India's total GDP, what's going to happen is the country's best managed companies with proven track record of execution are going to capture the bulk of this upcoming wealth creation boom in the Indian stock market. If you simply assume the market cap to GDP for India to approximate 100% over time, one can just imagine the amount of wealth creation that lies in store for great and good Indian businesses. Trillions of dollars, right? You should not miss out on this particular opportunity over the next 10 to 20 years. That is what we are positioning our small cases for at Stellar Wealth Partners, to greatly benefit from this upcoming wealth creation opportunity and build generational wealth for many working class families and business families in India over the next few decades. But have faith in India, have a long-term mindset, and enjoy the wealth creation journey.
Amazing. Thank you for this amazing session and great insight that you would give us. And viewers, do check out Stellar Wealth Small Cases. Do not forget, the link is in the description box. And if you want to see more sessions like these, please leave a +1 in the chat. And until then, thank you so much once again, Gautam. It was a great session. Viewers, if you'd like to see more such sessions, please like, share, and subscribe so that everyone can learn together. Thank you and have a great day.
Thank you, everyone. Thank you, Abel.